If you've been investing in mutual funds for a while and want to go beyond the basics, this episode is for you. While equity and debt funds are popular, there are advanced mutual fund types that can help you diversify and optimize your portfolio. Today, we'll discuss index funds, arbitrage funds, dynamic asset allocation funds, and thematic funds, what they are, how they work, and who should invest in them. By the end of this video, you'll have a deeper understanding of advanced mutual funds and how to use them effectively. Let's dive in. Mutual funds are not just about SIP and equity funds. There are advanced options that cater to different investment strategies. Let's explore them one by one. Index funds, the passive investing powerhouse. What are index funds? Index funds are passive mutual funds that track a stock market index like Nifty 50, which includes the top 50 companies in India, Sensex comprising the top 30 companies on BSE, Nifty Next 50, Nifty Midcap 150, Nifty 500, and so on. Instead of active fund managers picking stocks, index funds simply mirror the performance of the index. Why invest in index funds? Low cost. Since there's no active management, expense ratios are as low as 0.2 to 0.5%, compared to 1.5 to 2% in actively managed funds. Market-linked returns. Over time, stock markets tend to grow, making index funds ideal for long-term investors. No fund manager bias. Since they simply replicate the index, there's no risk of poor stock selection by fund managers. Example: if you had invested 1 lakh rupees in Nifty 50 index funds in 2010, by 2024, your investment would have grown to 5 to 6 lakhs, thanks to compounding and market growth. Pro tip: great for long-term investors who want market-like returns with minimal expenses. Arbitrage funds, a low-risk, high-liquidity option. What are arbitrage funds? These funds take advantage of price differences between the cash market, which is stocks, and the derivatives market, which includes futures and options. Fund managers buy stocks in the cash market and sell them in the derivatives market at a higher price, making a risk-free profit. Why invest in arbitrage funds? Well, for one, they are low risk. Since they use arbitrage strategies, there's almost no market risk involved. They often provide returns higher than fixed deposits or savings accounts, making them a better option. Plus, there are tax benefits. Arbitrage funds are treated as equity funds, so the long-term capital gains tax of 10% applies only after you've gained 1 lakh rupees. Let's take an example. If an arbitrage fund gives a 6% return annually, it is better than a savings account, which typically offers 3 to 4%, while also providing higher liquidity. Here's a pro tip. These funds are best for short-term parking of funds, say 3 to 12 months, especially in volatile markets. So, what are dynamic asset allocation funds? These funds automatically adjust their allocation between equity and debt based on market conditions. If the stock market is overvalued, they shift more into debt funds for safety. Conversely, if the market is undervalued, they increase equity exposure to capture growth. Why invest in dynamic asset allocation funds? Well, they are best for conservative investors. These funds are ideal for people who don't want to manage asset allocation themselves. Plus, they reduce risk by automatically reducing exposure to high-risk equity during market crashes. And for long-term wealth creation, they provide balanced growth over time.
And action.
Let's look at an example. During the COVID-19 crash in 2020, these funds shifted to debt to protect returns. When the market recovered, they moved back into equity, helping investors benefit from the rally. And here's a pro tip. These funds are perfect for hands-off investors who want a balanced approach without actively managing their portfolio. Thematic and sector funds are high-risk, high-reward bets. So what are thematic and sector funds? Well, sector funds invest in a specific industry like technology, banking, pharma, or FMCG. On the other hand, thematic funds follow an investment theme, such as electric vehicles, renewable energy, or digital transformation. Why invest in these funds? Well, they offer high growth potential. If a sector booms, these funds can deliver exceptional returns. They are also good for tactical allocation, as they can be used to capitalize on industry trends. Let's look at some examples. IT sector funds grew over 300% from 2010 to 2020 due to tech expansion. Pharma funds boomed during COVID-19 from 2020 to 2021, but underperformed later. Now, let's discuss the risks to consider. These funds are highly volatile. If the sector or theme underperforms, the fund can drop significantly. They shouldn't exceed 10% of your portfolio, as too much exposure can be dangerous. Pro tip: only experienced investors or those willing to take high risk should invest in these funds. Who should invest in these funds? Index funds are ideal for long-term passive investors who want market-like returns at low cost. Arbitrage funds are best for low-risk investors looking for better returns than savings accounts. Dynamic asset allocation funds are great for those who want a balanced strategy without manual intervention. Thematic or sector funds are suitable only for aggressive investors willing to take high risks for potentially high rewards. Golden rule: always check the fund's past performance, expense ratio, investment strategy, and your risk tolerance before investing. Advanced mutual funds can add depth and diversification to your portfolio, if chosen wisely. In the final episode of this series, we'll show you how to build a mutual fund portfolio that matches your financial goals. Don't miss it. Subscribe to Stock Glimpse India and hit the bell icon. Which advanced mutual fund interests you the most? Let me know in the comments. Like, share, and subscribe if you found this helpful. Happy investing! Summary of key takeaways. Index funds offer low-cost passive investing for long-term market growth. Arbitrage funds are a low-risk, tax-efficient option for short-term parking of funds. Dynamic asset allocation funds auto-adjust between equity and debt for stability. Thematic or sector funds provide a high-risk, high-reward strategy for aggressive investors. Now you're ready to explore advanced mutual funds like a pro.